Okay, I think we'll go ahead and get started. Good afternoon, everyone, and thank you for joining us for an inside look at qualifying for financial aid. My name is Gigi Lakites, and I'm a partner and financial advisor at PKS Investment Advisors. PKS Investment Advisors is a fee-based independent registered investment advisory firm, and we're affiliated with PKS & Company, a well-known accounting firm. Together, we offer an array of financial solutions and services from personal and business tax planning to valuations to retirement and financial planning investment management. We have 3 offices located in West Ocean City, Salisbury, Maryland, and Lewis, Delaware. So a few housekeeping items before we get started. We expect the presentation to go about 45 minutes, and we will leave some time at the end for questions. Please post your questions utilizing the chat feature at the bottom of your screen at the 50-yard line. In addition, we will be emailing additional information and resources to the email you used to register for this program. This event will be recorded and will be available for replay on our website at pksadvisors.com. So without further ado, I would like to introduce our presenter today, Colton Hastings. Colton is a financial advisor and a certified financial planner professional at PKS. He works closely with individuals and business owners to define their financial goals and fine-tune strategy in an efficient and sustainable way. So I'll let Colton take it away.
Thank you, Gigi. Hi, everyone. Thanks for taking the time to be with us today to learn a little bit about qualifying for financial aid. To give you a heads up, I'm having a little bit of internet speed difficulties, so if I look a little pixelated at any point, that would be why. But I'm glad you're here today and educating yourself on qualifying for financial aid. This is the best way of finding good schools at affordable prices, and getting ahead of the ball game is the best way. I'm going to start by saying don't rely on luck. A lot of people will just go and have their children apply to the schools that they want to go to and not do much of research, and then wait on the financial aid award to be received, and then they just go with that route. What you can do ahead of time is plan and determine what schools are the best option and with the best routes to go to get the aid. Okay, so the first step is determining if you will qualify for any aid and what aid you would qualify for. So parents often assume if they make a certain amount that they're not going to be able to qualify for any aid. So there's a lot of different factors that go into that other than just income. There's what kind of money is in, how much money is in checking accounts and savings accounts and investment accounts, as well as how much the student is earning and how much they have in their assets. And the process would be a lot simpler if there was just one specific number that said, at this level, you're not going to qualify, or at this level you are. There's a lot of different factors in the formula that determine what you will qualify for, and we'll go through some of that today. Now, the first major step in determining what you're going to qualify for or what schools you should look at is determining what your expected family contribution is, or EFC. Now, there's a couple different numbers that go into this formula. It's AGI of the parents, it's adjusted gross income of the student as well, as well as assets of the parents and students, and the number of children that are currently enrolled in school or plan on enrolling. Now, how this number is expressed. So you can go online and calculate it. You'll need your 2 years old tax return and some of your income. But what you will do is you'll go online and you'll plug all the numbers in requested, and then it will come out with a number. And that EFC number would be what you would be expected to pay. Now, there's 2 different formulas that determine your EFC. There's the federal formula, which is tied to FAFSA, which is what most of the schools are going to be using. Now, there's also the institutional formula, which is tied to the CSS profile. That's going to be a lot of your larger private schools. That's going to be most of the institution that use this different formula. So we'll probably focus mostly on the FAFSA formula today, because that's what you're more than likely going to run into as you're going out and applying. Now, here's just an example of how a need-based aid would be shown with your EFC. So you could see the cost of a certain private college would be $65,000 per year. And let's say you got online and you calculated your expected family contribution and it came out to be $10,500. That would be what you are expected to pay for 1 year of schooling out of your own money. So the need from that would be $54,500. Now, most schools, unfortunately, aren't going to be able to meet all of that need. So parents are probably going to end up paying more than what the EFC number shows. Now, here's an example for a low to middle class family. Let's say their AGI is $60,000. They have about $15,000 in cash and taxable investments, and their home equity is zero. Now, it shows both of the formulas here, and you can see that both of the numbers come out to be fairly close. Now, the FAFSA form or the federal form can come out to be similar to the CSS formula, but they can be different and depends on each person's situation. But you can see here that their EFC number comes out to be around $2,500 each way. Now, here's an example for an upper middle class family. Their AGI is $160,000. They have $125,000 of cash and taxable investments, and their home equity is about $200,000. And you can see it comes out to be similar again, with the federal formula being $34,000 and the CSS one being $35,000. Now, here's a little bit of strategy as to, depending on your circumstance and what your EFC number comes out to be, how you can move forward and how you can best approach what schools to go for. So families that turn out to have a low EFC number, you're going to want to reach out to schools that have very good need-based aid. So you're going to want to apply to in-state public universities, and you're going to want to make sure that you file FAFSA early, because generally you can get a lot more aid from state and public universities. Now, keep in mind that public universities outside of your state are going to be unlikely to provide need-based aid. They're going to be more based on merit aid. So you're going to want to look especially in-state. Now, here's an example of some strategies for families with a high expected family contribution. So you're going to want to look at a lot of different private schools or public schools, depending on the situation. You're going to want to look for merit scholarships, but you're also going to want to avoid the highest of the elite schools, because generally they're not going to provide many merit scholarships because they are attracting the students regardless of what their aid is. These parents will pay top dollar for their children to go to the school, and they don't need to offer the merit-based aid. Also, you're going to want to still look at in-state and also out-of-state public universities that give merit scholarships. Now, here's an example of what the letter can look like. So your EFC is going to be very handy as you are getting these financial aid letters to determine if the offer is good or if it just seems like a good number, but really there's a lot of hidden cost in there. So let's take this letter, for example. The family contribution is zero, which means their AGI is below $27,000. So in theory, they shouldn't have to pay anything to go to a university. Now, on this letter, the student received a grant for a little over $33,000, which seems pretty good, but it looks stingy when you consider that the expected family contribution is zero, and in this package, there's nearly $29,000 worth of loans in that. So while on paper it looks great, we're getting $33,000 for the year. However, you're still paying $29,000 in loans. So what I would recommend is not delaying on getting your expected family contribution. If you get ahead of ball game and have an idea of what your expected family contribution is, it's going to better equip you to be able to determine what types of universities to reach out to, whether that's going to be your in-state public universities, or if you're just going to shoot for the merit scholarships, probably your private schools and your out-of-state public universities. Now, the best way to do this is to go online to the College Board website, and they have an EFC calculator. That's one of the links that we will send out to you after this presentation. And the slide touches base on that. This is what it looks like on the right-hand side. That's what your different calculations are going to look like Now, the big question is, are my investments going to hurt my chances, especially at the parent level? So lots of parents are worried about that, and that's one of the larger questions that commonly comes up. And a lot of the brokerage accounts and the money in savings, the FAFSA is going to evaluate those parent assets at 5.64%. And I'll go through a little example. So let's say your family has a $75,000 worth of a 529 account. So that's going to be assessed at the parent level, and it's a parent asset. With this money assessed at 5.64%, that increases the household expected family contribution by only $4,230. So you've got 75,000 saved, and it only increases your EFC number by 4,230. Now, here are some of the assets that the FAFSA and the CSS profile both ignore. So your IRAs, your SEP IRAs, any kind of qualified retirement accounts, those are going to be ignored from the FAFSA calculation. So you could, in theory, have $500,000, $1 million in your work plan or IRA in your name, and it's not going to affect what your expected contribution would be. And the FAFSA profile also ignores annuities and cash value in life insurance policies. So here's another big question. Is the equity in my home going to affect what my expected family contribution? And the FAFSA does not ask families for the equity in their primary residence, and it does not calculate that into what your expected family contribution would be. Now, that's not the case if it's a secondary home or a rental property. They would ask for any equity in those. However, your primary residence would have no effect on your expected family contribution. So if you're going through and filling out the FAFSA, be sure that you do not include the equity in your primary home in your calculation. Now, the CSS profile is a little different, and that's actually going to depend on which school you're applying to. So they may assess the equity in your primary residence, they may not, or they may use a formula that would assess a part of your primary residence equity. So you'll need to reach out to whatever school you may be looking to and see how they are planning on assessing primary residence equity. Now, here's a couple other things that the CSS profile may incorporate that the FAFSA is going to ignore. So any adjusted net worth of a business or a farm, the CSS profile would want to include that. Non-qualified annuities, the CSS profile is going to want to incorporate that as well. And also sometimes, depending on the school, the cash value of any life insurance policies. Now, here are the major things that both formulas are going to be looking at to determine what you're going to be required to pay to go to each institution. So the main things that they are going to be looking for are any taxable assets, whether that be in a checking account, saving account, CDs, or in a brokerage account. They're also going to be looking at 529 plans, as well as any assets in the child's name. And we'll go through a little bit more of that in depth. So I want to preface this before we talk about the types of accounts and savings. I want to say, make sure you save. Your savings is not going to impact you that much, especially at the parent level. It's best to be prepared and save as much as you can for the education versus trying to not save it all and hope that you qualify for need-based aid, because a big chunk of that need-based aid formula is going to incorporate income. So even if you may not have many assets set aside for schooling, it's still going to look at your income, and your expected family contribution could still be high regardless of the fact that you don't have any monies in savings or a 529 plan. So save as much as you can, because the less you have to borrow, obviously, the better. And here's just an example to show you, if you save $10,000, how much is going to be affected on your EFC number. So the FAFSA is going to look at the parent assets at 5.64%. So every $10,000 that you save, it's only going to increase your expected family contribution by $564. And keep in mind as well that just because a student's eligibility for aid is reduced doesn't mean they would get more money anyway. So it's best to save and be prepared than hope and pray for extra need-based aid. Now here's a larger one. So the teenagers and the students' assets and incomes are incorporated at a much higher rate. So for the student profile at the FAFSA level, they're going to incorporate 20% of the student assets into that expected family contribution. And the CSS profile will incorporate student assets at 25%. So if they've got $5,000 in a checking account, they're going to want $1,000 or $1,250 of that available to pay for schooling. And also the FAFSA is going to allow students to shield a little bit of their income from being incorporated in that expected family contribution. For the 22 to 23 school year, the student could earn up to $7,040 for the year and not jeopardize any aid. Now, here's a larger topic. It's the custodial account. So parents may go out and want to put savings aside for their children for the future. And a popular one is a custodial account, brokerage account, and owned by the parents for the child. These are going to be considered child assets, even though it's a custodial account. So they are going to be incorporated at that 20 to 25% range. So you need to be extra cautious about these, especially leading up to college age. So one way to limit that, depending on what kind of gains are in the account, would be to liquidate that custodial account and potentially transfer it to a custodial 529 plan. At that point, that money would be incorporated at the parent level, which would be that lower 5 to 5.64% range. So this is a great option, assuming the timing is right. So you reach out to your advisor and discuss when you're planning on needing to file FAFSA for your child, and they can tell you whether it's a good idea to do this now or maybe we need to wait. So this, we'll discuss here some of the biggest influencers in the financial aid formula. It's going to be income from the parent's tax return. It's going to be non-retirement assets, including those 529 plans, number of children in college at the same time, and of course, the child's assets and income. And typically, the biggest influencer of this formula is going to be the parent's income, and the FAFSA formula assesses up to 47% of a parent's income in that formula for the expected family contribution. So, and here is a good thing that is starting to change, and this will be changing starting the 2024 to 2025 school year. So it used to be that grandparents' savings didn't impact the child until the money came out to go to the school, and then all of that money that went to the school was assessed up to 50%, and that's a stiff penalty when you're talking about qualifying for aid. Luckily, starting in 2024 to 25, the FAFSA will make outsider financial help a non-issue. So this way, grandparents, aunts, uncles, whatever the case may be, will be able to kick in as much money as they want to pay for college, and it won't have any impact on FAFSA and financial aid for those FAFSA schools. However, that will be slightly different for the CSS profile schools, and we'll go into that on the next slide. So the CSS profile schools and grandparents or any other relatives, if need-based financial aid is a possibility at one of these schools, grandparents should probably be strategic about when they help. There's not been any indication that these CSS profile schools will stop assessing financial help from grandparents and other family members, friends, etc. So you're going to want to be timing the grandparents' contributions to the schooling. So because we're using 2-year-old tax returns, grandparents and other family members could safely start contributing to the college cost in the second semester of the sophomore year. At that point, moving forward, we're going to be using 2-year-old tax returns, so we're not going to need to incorporate any of those contributions from the grandparents and other family members towards schooling. And here's an important point. If you're not going to be eligible for need-based financial aid, this isn't going to be much of a factor for you. So grandparents can feel free to do contributions knowing that there's probably not going to be any need-based aid regardless. And if you want to be safe with the grandparents' monies, have them contribute money to a parent-owned 529 plan. This would help avoid any issues prior to that change happening for FAFSA. And now we'll go through some of the ways to help you try to maximize your financial aid capabilities. Now, here's one of the biggest ones, and it's appeal what awards your student receives. So most of these colleges and universities, they're in buyer mode. They're scrambling to fill their freshman slots every single year. They're looking for new students even into the summer. In this environment, you can be successful asking for more money, whether it's need-based aid or merit scholarships. Doing this is possible even if your student has already accepted the admission offer and put down a deposit. That's because these schools worry about the summertime and what they call the summer melt, which means student commit, but then they fall out and never show up in the fall. So ways you can go about this: contact each individual school regarding what their procedure is for appealing an award. Some might prefer an online form or a letter that you send to them, just depends on the institution. And when seeking need-based aid, the more specific you can be, the better. So if you have a lot of unexpected medical bills pop up, or you have a relative that you're now taking care of, see if you can provide them as much information as you can about the situation. They'll be more than likely willing to work with you if that's the case. If a parent has lost a job or had hours cut, provide a letter from the employer stating the salary cutback. At the bottom line, the more documentation you can provide, the better. And here's another one: apply for aid as early as you can. So don't give a school an excuse not to award your child financial aid. Get it in as soon as you possibly can and meet all the deadlines they require. The first day you can complete the FAFSA and the CSS profile is October 1st of a child's senior year in high school. And keep in mind that there's some upcoming deadlines for Maryland and Delaware aid as well. Delaware wants you to have the application put in by May 15th of this year for the 2023 to 2024 school year. And Maryland's is actually coming up. It is March 1st of this year. So if you're in Maryland and you need to get that done, go ahead and get that FAFSA filed as quickly as you can. And here's another strategy that not many people think of. Another way you can either use those custodial accounts, or if your child has money in a bank account or savings account, use that money first, because that's going to be assessed at that harsh 20 to 25% penalty, depending on if it's FAFSA or the CSS profile. So that money is going to be much more incorporated in that expected family contribution. So if your child needs a car or needs a computer for school, or if there's test prep materials, things like that, try to use as much of their money as you can first. That will help trim down that 20% incorporated asset level and help you qualify for more aid. And of course, pay attention to the calendar. You need to know when that financial aid clock starts ticking. The base year being 2 years ago for your return before your student is starting school. So for the 24 to 25 school year, 2022 was your year. So since your financial situation can change, particularly depending on year to year during school, you can also request judgment depending on what your situation is from the school. So if you say my income has really changed or our asset levels have really changed, reach out to them and see what they need to do to determine that and what you need to provide. And here's another important one. In the years you're going to be using your tax returns for, see if you can minimize any capital gains realized. You can work with your advisor very closely on that. If you say, hey, I'm going to be applying for FAFSA 2 years from now, well, we need to make sure we're not selling any investments with any big gains. We could also maybe transition you to as many ETFs as possible. They're going to limit capital gains distributions. So there's some strategies you can use in conjunction with your advisor, or even on your own, of trying to limit those gains that you realize in those years you know you're going to be using your tax returns. And another one is be strategic when you file for these aids and when you use these forms. So if you've just paid a large bill, or, all your bills just came out of your checking account, the FAFSA is going to ask all of your assets the day you are filing. So if you can be strategic about, hey, the market just dropped 2%, or I just paid a whole bunch of my bills, or I had a large car repair, try to file then, because the lesser your assets are, the better, especially with those child assets. And finally, another important step is researching your colleges as much as you can. Try to find out what type of aid they are better at giving. Are they more merit-based aid? Are they good at meeting need-based aid? So research your schools and find out where you should be looking to on your child's list. Some of the schools are going to be better at the need-based aid, while other ones, like the private universities and some of the out-of-state public universities, that's going to be your best bet for the merit scholarships if you know you're not going to be qualifying for the need-based aid. So be strategic about it, do your research, and if you need a really in-depth research, college counselors can be a great resource and can point you to the right direction on what types of institutions, where, what states, etc. So they're a great option if you need that more in-depth planning. And with that, that's the end of the presentation. I was going to open it up to any questions that you may have, and Gigi will hop back on and kind of moderate those as well.
Thank you, Colton. Very informative. I do want to just check. I think when is the FAFSA filing date for deadline for the state of Maryland? I believe it's March
1st. Maryland's coming up.
So it's
Maryland's
coming up, and that is for the 23-24 school year.
Correct. Yep.
Okay. So it's important that if you wanted to qualify for the best financial aid available, now is the time to really get that FAFSA filed.
Yep.
Correct. Yeah. And can you, I don't know, you might have touched on this, and I apologize if you missed it, if I missed it, just there are more FAFSA schools, right, than CSS?
The FAFSA is the bulk of what you're going to run into.
Right.
Look at what schools your student is looking at. You can go online or go to the school website and see what formula they are using for that expected family contribution. The bulk of them are going to be the FAFSA schools. Most of the private schools, the higher price schools, those are going to be your CSS profile schools. So just do some research if they are looking at some private institutions and see what formula they're using.
Okay. We do have a question. The question is, are we required to file a FAFSA every year that our child is in college?
You are going to want to, because it will open you up for any type of aid that you're going to receive. So any year that your student is going to be in college, you're going to want to get that filed, because that's going to give you the option, not only for loans, there may be some grants out there, things like that. So you're going to want to file it every year they're in school.
Great, yeah. I don't see any other questions at this time. If you think of a question after you leave the webinar, feel free to reach out to us. Please look for the follow-up email with those resources that Colton mentioned. There's always, we're always here to help if there's any other questions. So with that, thank you, everyone. Thank you, Colton.
Thank you, Gigi. Thanks, everyone, for taking time.